We start with the group of stocks that just can't stay down. Tech making a Rocky-esque comeback. After a rough earnings season, as you know, it's the best performing sector of the past week, while FANG is leading the charge. Names like Salesforce, NVIDIA, Cisco, and PayPal all joining in on the party. Guy?
Yes, sir.
Tech's back.
When did it leave?
Well, there was a bit of a lull.
It left in the form of maybe Facebook, if you want to jam that in there.
Netflix.
But, you know, you mentioned a couple.
Netflix, NVIDIA.
Right, Netflix.
I mean,
should we go on?
I don't think Netflix is a tech stock, but that's an entirely different conversation. You look at Salesforce. I mean, that's a stock at a valuation that trades in. That stock should have gotten obliterated. It did not. Adobe's another name, huge valuation. Didn't really sell off that much. So the tech that we look at almost every day sort of hung in there.
Oh, but a lot of the glamour names, in fairness, a lot of the glamour
Netflix,
names.
Tim mentioned,
had a bit of an
NVIDIA,
upset.
yes.
Facebook.
I mean, Intel's had some issues. Facebook's its own animal. But I think tech in general is actually held in there pretty well. So I would push back and say, yeah, there have been some names that have had issues, but tech in general has done pretty well.
Jimmy Jamison, lead singer of Survivor. Scott, that's important because we did Eye of the Tiger on the way in.
Awful song.
And it might be one of the worst ever. But when I think about tech, I think there's been a little rotation. First of all, we've absolutely seen semis fall out of favor. And this was, and I don't think that the semi story is over, but I think the high multiple, high momentum stocks are in a prove me period. And I think, say what you want, but this market has been led by transports, it's been led by industrials, and I would argue that banks have put in a good show. Healthcare for sure. So, no,
discretionary?
I don't think you chase tech at all costs. I don't think you ever did. But valuations seem to matter a little more in this market than they did a month ago.
Karen?
I don't think that. The earnings have been pretty good. Apple was very good.
Great.
Amazon, very good. Alphabet, very good. Facebook and Netflix, not as much. Microsoft, very good. So I don't know. I don't know why they sold off the little they did. I don't think that should have happened. I still think even with them here, even with the market up very close to its all-time highs, there's value in some of these tech names.
Well, yeah. Google for sure.
Yes.
And there's plenty of places you can go still in tech if you were looking for value, but also there's an area where we kind of go here and there, but they have a little bit higher valuation, which makes them a little scarier. And I bring up something like Amazon, NVIDIA, some of these various names where you look at the valuation levels and you're like, wow, man, that's pretty expensive. But the growth is still there. And because the growth is still there, people are willing to look past the fact that many of these multiples are extremely high. But I agree. I mean, the sell-off in Facebook absolutely did pull down the market for a day or two. That ended.
Look, I think
when you go through the numbers,
if nothing else, it caused a somewhat deeper conversation on whether value was going to finally, take the place of growth for a while. Now we're looking at these tech stocks, as we said, 1 week performance: Facebook 8%, Amazon 5%, Salesforce 5%, NVIDIA 5%, Cisco 5%, PayPal 4%. I mean, I could go on, but those are names I have in front of me indicative of how these stocks have come back.
To Pete's point, I think the Facebook absolutely rattled some chains without question. But then you look at these stocks. I mean, you look at stocks, again, that should have gone down in a significant way, given the valuation, given the runs that they've had, and they really haven't done that much. I mean, you can make an argument that Microsoft at 28 times, maybe people look at it and say, that's an expensive stock. Maybe we should take profits. Really didn't happen. And again, Salesforce is another name at 60-time forward earnings. You had every opportunity to sell that stock off. That didn't happen. So Facebook notwithstanding, I don't think, again, my point originally is I don't think tech really ever left.
And it's a forward-looking market. When you're looking forward, you look at the forward PEs, a lot of these companies, right? And all of a sudden you look at Microsoft, it's not as expensive. I mean, you look at many of these various names, and you look at the growth trajectory right now in many of these names. It's really there, Scott. I mean, there is actual growth, and those that are really focused on the cloud are crushing it right now. And because of that, I think you have to look, first of all, I never buy anything just because it's value or just because it's growth. Combine them both, that's the stocks I
think
want.
More impressive to the fact that we're knocking on the door of new highs is the move in healthcare in July. Got hit a little bit today. Discretionary, I think, closed at a new high today. Financials are carrying their weight for the first time in a while again. Those have to be viewed as more positive signs for not only getting to these new highs, but exceeding the
100%. We talked about healthcare the last couple of weeks. We actually did a power pitch. That's something we do on the show. I know you host.
I've seen it. It's called a fast pitch.
Fast money, fast pitch.
Just letting you in on a little secret. We've only done it for 2 years.
So we did the power pitch a couple of weeks ago. We did it on Pfizer drug. And we talked about right after the president went after Pfizer. We actually had a conversation on his desk that said that's going to put in the low for Pfizer for quite some time. You have not seen a 3 or 4 week move in Pfizer drug like you've seen over the last couple of weeks in the last 6 years. Something clearly is going on. Talk about value. I think big cap pharma is value. I think the bullseye was on their back. I think it's now off their back.
When I look at this market and I look at where we were in Jan 26 and then the move down and all the volatility in between and how the market is now kind of rallied, I think the outperformance of transports, which is probably about 7%, of banks, which is probably about 4%, of the discretionary, so whether it's not necessarily XRT, but individual names in that retail space that have been on fire. And most importantly, earnings, I think, gave credence to the argument that those cheap valuations were worth owning. Look at the rails. Look at what happened to the airlines. Look what happened with the banks. I mean, this, to me, this is the nice thing about earnings. You get fresh data points on companies that are giving you and reaffirming, and in some cases beating. That is important to the market.
Got some retailers coming up in the near term in their earnings as well. And as we said, discretionary is doing well. What are you watching most?
Well, just today in discretionary, Michael Kors, which is both a beverage and a clothing company, versus our final trade last night. And those are good numbers, and that bodes well for a lot of others in the space. We saw Dillard's today with really excellent numbers. It's really interesting to me, though, that all of the different industries you're talking about, healthcare, which kudos to Guy, he's been on it for a long time, healthcare, banks, retail, transports. You know, a lot of times we hear the story of, oh, all the gains are coming from a very, very narrow sector of the market. It's just FANG. And that's not true anymore. So
I don't know that it was ever true. I mean, I realize that the FANG names actually were a big percentage of the S&P. I fully get all that. But I mean, the reality is outside of that, Microsoft was doing well. That's not in the FANG. I mean, there's a lot of names. Pfizer, you just mentioned.
Right,
I mean, healthcare.
If you went a little more broad outside of the FANG, you still had 6 or 7 stocks that were accounting for like 90-some-odd% of the S&P's gains.
But the names outside of that were also performing. I mean, I think that's the part that gets lost a lot of people. I mean, a great example of that would be Merck and Pfizer and a lot of the different drug names that are out there. And there's been a real run, although it's pulled back recently, but in the biotech world.
What about the notion in that particular space of it has a more defensive posture? So the market has been a little more defensive lately. Morgan Stanley was out with a new note today talking about, 2 of the 3 legs on the stool being knocked out of the market, and now wondering whether Apple's $1 trillion market cap thing was a potential sign of the top, that was the lights flashing and say, okay, market seems to be a little more defensive lately.
Legs, Scott?
Apple hits. I don't remember exactly what.
Okay,
I'll pull up the note as you're talking. I'll look at it.
The reason
one of them was the more defensive posture.
Well, look, I think Apple was actually doing nothing. I think Apple was actually, until they reported, if anything, it had been slightly defensive, but it really had been kind of a sideways move. And I think the earnings told you once again that there was a reason to reaffirm. It was sales, it was services. But I look at some of the other parts of the market that we wanted to see take hold: banks, transports, and I repeat, I think this is where the strength in the market is coming from, because I think what Pete's saying is tech's going to continue to do what they do.
Right.
And therefore, if we get the broader support, that's what the S&P needs.
And with the 10-year now at 3%, or give or take right there.
Which people are very comfortable with.
Look at the financials. And overall, they've had a very good month, and obviously started off with earnings, but you're talking about 6% for the XLF in the last month or so. That's pretty impressive.
To me, the biggest risk this market has, we're all thinking, oh, they'll work out trade. They'll work it out. Won't be a problem. Doesn't matter that the rhetoric keeps getting ratcheted up. That's the biggest risk, because if they don't work it out, there's a lot of downside, I think, to a lot of different industries. And I think there's some upside if they do work it out. But we're Karen, just assuming it's all going to be fine. I'm sort of making that assumption. But with the VIX here, I think it's good to own some puts in your portfolio.
I think that makes a ton of sense. This morning, though, we get an announcement that China slapped another $16 billion worth of $16 billion in tariff as a group, and the market yawned. I mean,
because they think they'll work it out. You think everyone's just accepted these tariffs are really going to happen, and that's going to be the new way the world trade works?
Well,
I don't.
I'm not sure. And I would agree that ultimately the inflationary implications of a 10% tariff on the global economy is got a 10% hit on equity valuations. I don't think people are thinking about that. But I think people are looking at the reality, especially of consumer discretionary and banks and transports, and I don't think they're terribly concerned about tariffs. Once they've truly done their work, I think a lot of these sectors actually are more, more impervious and are going to be defensive in that environment.